Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. Our guest today is Nischal Maheshwari of Centrum. Nischal, great having you. Thanks for joining in.
Welcome.
Nischal, a bit of a wobble in the markets. To a few people, they ran ahead of themselves, preempting certain things from the global central banks, which haven't quite turned out the way the markets would have anticipated. What's your sense? Could this wobble become magnified, or we meander around these levels before the next set of cues come in?
So I think basically this was expected in the market actually. I think 50 basis point if you look at the dot plot basically, it was expected. And I think the Fed has also said the same thing. The only thing which is differing from what the market was expecting is Mr. Powell coming and saying that basically he needs to see more data basically before he thinks that the peak has been made of inflation, and I'm not surprised by that basically because if you look at it, the labor market, the unemployment number, the wage growth in the US is still very good. So that's where the problem remains to be, and that is you cannot sort it basically just because you are increasing the supply or something. This is not a bottleneck actually because of supply side issues, or you can reduce demand here basically. So the issue is basically that a lot of people have got out of the employment roster, and they are not coming back. So that is the issue basically. And I was in July out there, and you could literally see basically at the blue collar level, there has been demand, amazing demand out there. Every store has put out a ad in the front window basically that they require help. So it was very evident actually that the labor market is still very hot, and I think that's where I think Fed is worried. So that is what has spooked the market. I think somewhat wobble has happened. Will it become a bigger one? At the moment, I don't see it. But I agree with you that the market is running ahead of it times, basically for the reason because this kind of aggressive rate hike, whenever we've seen in history, has always led to a U.S. recession. And I believe basically the recession will hit either the second quarter of calendar year or the third quarter. Most likely it will be the third quarter of the calendar year and may continue to the fourth quarter also. So that is where my worry remains to be.
Hmm. So you reckon that the Indian markets could show a sizable pullback in such a scenario? I'm presuming that markets price in news 4 or 5 months ahead of the actual event. So if the US markets were to correct, if they would, in the first half of 2023, do the Indian markets show a meaningful pullback as well, or we kind of escape relatively unscathed?
No, history has said once again, basically that Indian market has been actually more severe pullbacks than the US markets whenever US recession hits. And what happens basically, this is a study which we've done recently, and we are putting out a note on that. Rather, we have put out a note also once, and that study says us in the last 3 decades, whenever a very aggressive rate hike, it obviously leads to a recession, and then Fed pivots, pauses, and thereafter, basically, given that the outlook is bad, Fed starts cutting rates, and that is the time basically when the market tanks. And out of the last 3 decades, 4 times it has happened, and in each of these 4 times, basically, an average pullback has been of more than 20% in the US market. And Indian markets has not been unscathed. They have rather actually underperformed the US markets. So whether it was this COVID times, 2008, 1991 basically pullbacks, and 1980 pullback. So all these four recessions, you really study basically, you will look at it that Indian markets are not unscathed because of US pullback. India will react. I'm very sure basically, and that's why I'm telling people that you should be cautious in this market.
Interesting. So, Nishant, if if you were to have a model portfolio, would it have sizable dollops of cash currently, or would it be bent towards defensives? I'm just trying to understand.
So I wouldn't want to go on to cash at the moment. because there is still a lot of liquidity in the market. So I would be want to remain fully invested, but now I would start looking for defensives basically. So I've been aggressive on the banking side for some time now. I would start cutting banking rates, banking investments, and more into the defensive sectors. Like auto has underperformed quite a bit basically for some time, and there seems to be good value out there. So good defensive value picks is basically I would start looking out for.
Very interesting. Uh, and that's an interesting call, considering the fact that Nischal, most beliefs are of the results from the banking space likely to be the best amongst the large cap indices the whole of 2023. You're still making that call because you believe the valuations have moved ahead of themselves?
So I believe, Neeraj, that either this quarter or the next quarter, the banking earnings are going to peak out, and then the YOY numbers are going to start getting hit. This thing, and I think if you really look at it, most of these banks have now up almost around 15 to 20%. So I think that's quite a good, or more than that actually. The whole the banking index is up almost around 25%. So most of these must be up there. So I think that's a good run up which has happened. When you are facing imminent recession in the consuming economies of the world, so not only US but Europe, both will go into a recession. That is very sure. India's exports are 20% of the GDP. You can't be just wishing away and saying, okay, no, everything is fine across the world, and whatever happens in the world, India doesn't get impacted. You've seen basically whatever happened in the world. Basically, we were not so concerned about inflation, but our rupee just tanked.
Yeah.
And that is an issue basically because the world is now much more wired than what it was earlier. And one thing pops up somewhere, basically it starts showing on your balance sheet also in some way or the other. So I'm saying that could be a big issue basically, which I think market is ignoring at the moment because we are seeing very strong flows. But November has started giving you some jitters as far as flows is also concerned. I'm saying on an average, we are doing 10,000 crores plus basically on a net basis. Suddenly, November, you've seen basically 2,000 crores of net inflow. I would still believe basically this is a one-off kind of a thing. But as we go ahead, we'll see basically whether this is also tapering off. And if the FIs become negative, then I think we will see some good correction in the Indian market.
Yeah. Uh, Interesting. In which case, Nischal, couple of pockets wherein we've seen cuts in the better part of 2022. You mentioned autos being a pocket, so yes, for sure. Aside of that, we've seen every industry wherein the input cost pressures were high getting impacted in some fashion or the other. Now that may reverse in 2023. Do you reckon that markets will reward some of those commodity consuming companies if indeed the operational metrics show far better performance, because the YOY comparison numbers also will be strong that way?
I totally agree with you there, Neeraj, basically, because I think FMCG, so they were hit both from the side of the from input cost as well as packaging cost. So both of them have actually hit them. So I think FMCG margins should start coming back. I think demand is because they are largely domestic. So if we believe basically that India is not going to be impacted much as far as world recession is concerned, then you would be okay basically saying that domestic plays are the one to do. So that's why I'm saying auto, cement, FMCG, to an extent construction. These are some of the sectors basically should do well. Banking also, I continue to believe will continue to do well, basically because we are not hugely levered at the moment. But I think basically banking seems to be hitting a peak as far as valuation is concerned. That's why some corrections might be in store for them.
Okay, the FMCG point is an interesting one because I think a lot of people are talking about how the rural consumer might also come back and that might aid that space. The other one is information technology, Nischal, got hit majorly, has bounced back a little from the lows. And while it remains an export-oriented theme, the margin numbers might start looking better because of the manpower cost issues, maybe ebbing the. So how do you kind of think about both of these aspects and therefore the fortunes for tech companies?
So I, at best, would be a neutral kind of a situation,
Okay.
basically. Yes, something positive is there, basically, as far as margins are concerned. But then the growth concerns are a bigger one. And we have done one report. Maybe at some point in time, we should maybe do a show on that. And this is a report basically where we have actually looked at the last 10-year cash flows of our whole universe. And that one thing basically came out very interesting is basically that the market actually doesn't reward much of cash flows, but it is growth. And the stocks basically which had very strong cash flows but didn't show much growth, market has not rewarded them
Okay.
actually. And guys who have shown strong growth and never shown a in the last one decade not shown a free cash flow for a single year, they are some of the best performing stocks. So I'm saying growth is the prime mover in the emerging markets, and that is a very so if growth is wanting in IT, I think we should be at best neutral in IT.
That would be a fascinating conversation to do. We should do that sometime in January, even though we are right now talking
Definitely.
mid-December, Nischal. But I have one final question before we wrap up today's show, and that is the dichotomy in metals. Input cost pressures will ease. Companies are hopeful of prices holding out, but enough and more people are telling me that despite the whole noise of China opening up, the fortunes may not really dramatically change. What is your view on metals, Nischal?
I've been negative for almost 6 months now, and I continue to hold my view. When you are seeing a recession in the world, there is no question of saying buying a global commodity. So all metals should be basically underweight in your portfolio. If you want to play commodity, I think oil is one. Cement is one which you should play. Basically, it's largely domestic consumption, and government is very, very focused onto the infra side of it. So that is what you should be playing. Basically, I don't think so anything. One more interesting sector is the OMCs. Now, falling oil prices will definitely improve their margins. They are at record low valuations, basically. So I see OMCs basically doing very well. So I think oil sector, which has been neglected for a long period of time, I think you should start going and looking at it. Again, the gas sector totally. Once again, if the falling gas prices, basically, I think consumption will start going back. So I mean, oil and gas sector as a whole, basically, one should once again have a relook at that. We believe basically that could be a sector which should surprise a lot of people in the current year.
Thank you. So the China opening up theory for metals doesn't quite hold, Nischal, to your mind.
So my point is basically, yes, China will open up, but then the demand will fall across the other parts of the world. So US and Europe. So China has been a biggest exporter everywhere. So yes, the domestic consumption may go up, but if you are saying basically that the world market, the world consuming bowls, Europe and US head for a recession, then I don't see any reason for being bullish on the metals.
Got it. Well, but the oil and gas answer is a clincher of sorts. So thank you for that. Thank you for all the questions or the answers today, Nischal. Really appreciate. And I'm looking forward to having a conversation with you on that very interesting thematic note that you guys would have put out. We should try and do that sometime in January.
So we actually now this is the second edition, Neeraj, and we actually put out a yearly book on this now because it was a very very appreciated first time. Second time we have taken a few people's views. Basically, say, a lot of CIOs told us basically saying that how you could make it more interesting for us, and that's the second edition. And every year we hope to come out with something and show you something new on there. Basically, so it's a book. It's called a Blue Book, and I'm happy to have a conversation around it whenever you see it fit.
Most certainly, in the first or the second week of January, as soon as the holiday season is over, Nischal, would love to talk
I'll
to you
send a
about it.
copy of that across to you.
Looking forward to that as well. And thank you so much for
Okay,
the
thank you.
conversation today. Viewers, thanks
Thanks,
for
Neil.
tuning in to this edition of the Talking Point, and watch out for the Blue Book discussion with Nischal Maheshwari sometime in January on PQ Prime.